Wealthies, welcome back. If you're new here, this is All the Wealth. I'm Mical Jeanlys-White, the founder CEO of Wealth More. This is our wealth building channel where we bring insights, updates, and today we're here because tariffs are upsetting the markets, and we wanted to get on and give you guys the insights and tips that you need. And with me is Tanya, our head of wealth planning. Definitely a day for Tanya to be back. I personally have missed Tanya because we've been doing sessions with other folks on the team. So woohoo, Tanya's back.
Happy to be back. And I'm also happy that we've had our awesome team members on the podcast. I've been looking forward to everyone else getting to see how awesome the whole Wealthmore team is.
Yes.
But I am happy to be back today.
Yeah. And I'm happy to have you back, especially as we're talking about tariffs, because 70% of Americans don't have access to a wealth advisor. And when things like what's happening in the market over the last few days and what likely will be with us for quite some time happens, many of our investors who don't have the benefit of a wealth advisor are likely to panic and are more likely to exit the market having bought high, selling low, and then even more tragically likely to sit it out for some amount of time again. So today's Friday, April 4th. And on Wednesday, April 2nd, let's just call it Tariff Day, our administration shared a sweeping amount of tariff news that frankly surprised the market. If you guys were tracking the market leading up to Wednesday, the market had already made some corrections, had repriced in anticipation of the tariffs. And some people thought the tariff news would be less. So the market was like, oh, we will get tariffs, but it won't be as dramatic. Well, that's not what's happened. The tariff news has been pretty dramatic. And let's just start off with the first set of tariffs. So just to catch you guys up, there is now a base tariff for all countries that we import goods here, and that's 10%.
Yes, that's the tariff that is applied to the countries that we have a trade surplus with. So everyone has a tariff. No one's immune.
No.
What a tariff.
Yeah, I'm calling that 10% like a universal tariff. Like if we import goods from your country, there is a 10% tariff on that. And then there's the second wave of tariffs, which have been called, I guess, the customized tariffs for certain countries.
Yeah. That is a tariff based off our trade deficit with that country. So trade deficit has nothing to do with tariffs, but to this administration, it does. That's how they were calculated. So figuring out that country, our trade deficit with that country, and then applying 50% of that deficit as the tariff.
Yeah. And for those of you not as familiar with the trade deficit, that's essentially where we buy more things from that country than they buy from us. And so China is a great example of that. Vietnam's another great example of that. This is where some of these bigger tariffs have kicked in. 60 countries have these sort of reciprocal tariffs that have been levied, and China being one of the ones with the larger one. Even more news, which came in earlier today, is that China has also responded with some 35% increase on the tariffs that would be applied to the US.
Yes, that was just announced this morning.
Yeah. So the markets have been reacting. Like there's been nowhere in the market, both domestically and globally, that hasn't had a strong response to this. And then the last piece of tariffs are certainly the auto ones. And on autos, we've applied a 25% tariff. So I know
So some countries have double tariffs.
Yes. Yes. And I know even in our local market, people were rushing to the dealerships to buy cars because, car is already a big ticket item. You add on 25% to the cost of that vehicle, and that becomes a showstopper for most people.
Yeah, of course. Which also increases the price of used cars.
Absolutely. And the servicing of your vehicles too. Because if your parts are coming from outside of the US, that means even your existing vehicles, to service them, the price goes up.
So, so it's everything. It's the things that we buy. It's the things that we eat.
Yes.
It's the products that we use on a day-to-day basis. This is how global trade was set up, right? So that way, a factory in Cambodia can be just as productive as a factory here in the United States. That was the whole basis of global trade. But now we're all globally dependent to get
Yeah.
our goods and services from each other, making it very expensive now for everyone, not just Americans.
Yeah. And the tariffs were intentionally announced after 4 o'clock, so after the markets closed on Wednesday. Thursday was the first trading day after the news. And what we saw was that the S&P went down by 274 points, so almost a 5% drop in the S&P. And as we've shared on this podcast before, the S&P is heavily weighted technology. The Dow Jones, which is more of our staples, every day you can call them sort of like the blue chips, went down almost 4%. So we saw that go down by almost 1,700 points. And then lastly, the NASDAQ as well went down even more dramatically. And again, NASDAQ, heavily weighted tech, went down 1,050 points, almost 6%. I think probably the combination of the NASDAQ and the S&P, given their heavy weight on technology, were sort of, I don't think anyone was particularly surprised by that, but the drop was pretty dramatic.
Yeah, we have so about 30 minutes ago when I looked at my phone to see where the market was, like, oh, it's not so bad. The Dow's down 1.8%. No, that's a comma. 1,800 points. The
Yeah.
Dow is down, right? So these are precipitous drops. And anyone who knows anything about trading, Friday's a terrible day
Yeah.
to have the market go down at the rate that it's going.
And Tanya, that's on top of the drops from yesterday, right? So you've got sort of another day of dramatic drops. And just as we've talked about the Mag 7, so for those of you who may not be as familiar with the Mag 7, the Mag 7 are known as sort of like some of the biggest tech stocks in the world. So that includes Alphabet, which is Google, Amazon, Apple, Meta, which is your Facebook, Instagram companies, Microsoft, Nvidia, and Tesla. And just yesterday, those 7 companies lost $1 trillion in market cap. So what is $1 trillion in market cap? It is essentially the market saying, we believe these firms, based on the shares they have outstanding and the price, are not worth or are worth $1 trillion less.
Under these conditions.
Yes, under these conditions.
These are macro, so high level effects on the market. So it's nothing that the company themselves have done. There's nothing changed today in terms of their operations. These are circumstances outside of their hands that affect stock prices.
And I just want to dive into, I know some of you out here are wondering, well, what is the purpose of these tariffs? Like, how long will the tariffs sort of be out there? And that is a big driver for the uncertainty you guys are seeing in the market, because we are unclear as to whether or not the tariffs are a short-term negotiation tactic between our administration and foreign countries. We don't know how long these tariffs will be in place, if they are short-term because they're part of a negotiation strategy, or if they are meant to be a long-term strategy to bring more manufacturing onshore. So when you look at the auto tariffs, the auto industry believes that that will drive more manufacturing onshore. So in the absence of knowing if these tariffs are a negotiations tactic and may go away or may get reduced, how long these tariffs are here for, and whether or not these tariffs are a bigger part of onshoring, bringing back more manufacturing and development here to the US, the market is just reacting quite aggressively to the news.
Well, the market doesn't like uncertainty. So this is a policy that will have dramatic effects. As Mical said, we don't know what the real objective is. Is this a long-term play? Is this short just for negotiating? If it is a long-term play, then that's a scary position to be in, because markets will adapt, right?
Yeah.
It's quite possible that manufacturing will come back to the US. That doesn't happen overnight. That takes
No.
years and years to do. And that's sort of the factor that not worries me because I've been through so many market turmoils in my career. There's always something, and it's never a dull moment. But there's a lot of uncertainty. And the one thing the market does not like is uncertainty.
You got it.
Very hard for companies to plan.
Yeah.
It's very hard. Makes it very hard for people to understand the objectives, the growth, the projections of companies,
Yeah.
not just here in the US, but all over the world.
And I want to dig a little deeper into like uncertainty and sort of things that the market knows these tariffs, and really we should consider them global tariffs because the other companies with the reciprocal ones are also responding, right? So this is not just a US event, is that higher prices drive inflation.
And temper growth.
Yes.
No country wants to be stagnant. Every country wants the opportunity to grow, to be able to purchase goods, to be able to sell their goods. And higher prices across the board helps no one.
And so for you guys, the Fed has two responsibilities. It's to keep employment high, so unemployment low, and to keep inflation low. Inflation is already at 4-ish% now. And the goal for the Fed for the longest has been to get it to 2-ish%. And the expectation is with everything costing more, you're going to see that inflation continue to go up. And so the market is responding to that as well. The market is also responding to the expectation of lower earnings, right? So for every company that now has these higher costs, and it means higher costs for the food that you eat, that you're buying in the grocery store, it's higher cost for your iPhone, higher costs for your everyday goods. The companies are either passing that cost on to you guys, absorbing some of it, and it means the profits go down.
Profits go down, and the Fed has a limited amount of tools that it can use to keep inflation down or try to lower it.
Yeah. So if you're
There's a lot going on.
So if you're wondering, well, why is my stock getting hit so hard? Is because generally that price that you're paying for a stock is a multiple of those earnings, so that profitability. So when your company is viewed as likely to have less profitability, lower earnings, then that means it's less valuable. And the market says, well, maybe NVIDIA shouldn't be $110. Maybe it should be more like $93. And that's what you guys are seeing. And I use NVIDIA as an example because I know so many of you are likely to own it in some way, shape, or form. But the market is doing the same with all of the Mag 7s, particularly because places like Apple, companies like Apple also have a lot of their manufacturing and supply chain offshore in places like China and Vietnam. And now there's a tariff on everything. So that means the price goes up, the earnings go down, and the market says, well, for these types of earnings, I'm not willing to pay as much for Apple.
Yeah. Yeah. And it's an interesting thing to experience things like this, at least market downturns that happen this quickly. And our access to information is so overwhelming. So to give you an example, my son is he's 13. He's doing a financial literacy project in school. His stock is Amazon. I started to get, little emails throughout the day saying, "Mommy, what's happening?" I don't know what you're talking about. Amazon is going down like crazy. So you have a class of 13-year-olds that this is their project to track the market. What an experience.
And I would say that with that, right, comes the R word of, we've always been talking, or in the last few years, we've talked about a soft landing and keeping the US out of a recession, which essentially means the economy's not growing. Now, absolutely.
Yeah.
Right? The Fed has been working hard to make sure there was a soft landing, and we did appear to enjoy a soft landing. But now, with these moving parts, the word recession is now coming more and more into play. So you guys are feeling it, seeing it, and this is certainly impacting things like your 401k. It will impact individual stocks that you guys may have. But I think it's important for us to talk about why diversification matters so much in these uncertain markets. It matters in general, but if you were heavily into the S&P 500, heavily into tech stocks, these drops are oversized for you because these big firms where these indexes heavily represent just one sector.
Or even in a situation like this where you have stocks down overall, right? There's no safe hiding place. Gold has gone down as well, which is a hedge that we use here
Yeah.
at Wealthmore. So it's nowhere near down as from a percentage standpoint as the rest of the market. But when you experience everything going down, I think what gets undervalued is the experience of it, right? It's not like we've never had a recession before. It's not like we've never had a market downturn before. But what you do in those instances really impacts your growth and your wealth over the long term, right?
Yeah.
How do you get through it? We mentioned an event, a tariff event that has never happened in the modern state of the United States. So no one knows what the outcome will be. But it's not the first time we've experienced something uncertain, right? So how you behave when it comes to your money, the things that you do during that time frame is very, very, very important because we cannot control what the market does. It's always going to do what it does. It's what you do that's most important during these periods.
Yeah. And we've talked a bunch about the importance of having strategies that make sense for you and where you are in sort of like your life cycle and the amount of years you have to sort of weather ups and downs in the market. If you're a younger investor, this may be a unique opportunity to get into the market at lower price points. You also have way more time in the market and to continue investing before you would need to pull those resources out for retirement, let's say. So if you're a younger investor, please go to wealthmore.net, schedule one-on-one with Tanya, any of our other wealth advisors. Really want you guys having a deep conversation around how you might seize this as an opportunity.
Right.
Now, if you're an older investor, and I've had a number of them reaching out, and if you were not properly diversified, this is quite a shock. If you're near retirement, in retirement, same bit of advice, schedule one-on-one, meet with one of our wealth advisors. Having the benefit of that advice is so crucial so that you can look at your unique situation, do a deep dive into your financial plan, and make sure your assets are where they need to be based on when you need and may rely on those assets.
Right. And it's important to focus on the fact that Mical said your financial plan. Your investments are one part of your financial plan, an important part. I'm not discounting the importance of it, but it's one piece, right? When someone is in retirement and withdrawing funds, there might be a different strategy that they can implement to withdraw funds that allows them to weather these periods better, to put them in a better position. There's a lot of things that people can do to ensure that they continue to build wealth even in these environments.
I mean, the number one thing I want you guys to not do is panic. Very few decisions or good decisions come out of being made when you feel like your back is up against the wall and you're feeling like distressed and you don't have all the information and you haven't had an opportunity to speak to a professional that can help you. So rule number one, do not panic. These things, as Tanya mentioned, are part of investing. We've been through recessions before. And as Matthew and I covered in the last episode, because now this is our third episode talking about tariffs.
It is.
This is episode number 3, discussing tariffs. So you guys are welcome to go back and listen to the others where we went deep into the recovery that comes out of uncertain markets, how the markets correct and they come back, and over the long term, the markets are still some of the best returns you will see. And I know we can tell you guys this all day long, but it won't change how you feel today, how you may feel on Monday. I don't expect you guys are going to get a glimmer of like brighter news over the weekend. So we know there's sort of like the rational things that we talk about. And then there's the emotional side of logging into your account and being like, whoa, where is my money?
Yeah, it's an important emotion. There are times I can look back on when I had my practice, when I encounter a client that had never invested before. And I'm not talking about a young person. I'm talking someone in their 40s or 50s that had never invested in the market before. Accepting the awareness that they need to invest, they need their money to grow. And I would tell them to do it in baby steps, right? Don't just go all in all at once because you've never experienced being invested in the market. And the worst thing you could ever do is sell out of fear and that'll really upend your financial plan. And some of them be like, no, I'm gonna be fine. You have to go through it, right?
And there's nothing better than having access to a wealth advisor to help you through this. You can download the Wealthmore app. Community is free. Schedule a one-on-one. If you're already a member, feel free to use the message button, schedule one-on-one. If you have a burning question, reach out to your wealth advisor. Frankly, investors with wealth advisors do better, 2 times, 3 times better. And it's because of the ability to call someone who's looking at the market, who's informed, who can look at your existing investments to see just how much exposure and risk that you have. And hopefully you guys are investing in our managed portfolios where, to Tanya's point, we have hedges like gold. We're looking at markets outside of the US. We're looking at many sectors beyond technology so that all of your eggs are not in one basket.
Yeah, and if you happen to have a wealth advisor already and you can't get in touch with them during this period, you can certainly reach out to Wealthmore. We'd be more than happy to help you.
Yes. And it's why we come on here as things are breaking in the market. One, we think it's important to level set. These things are happening. They're just not happening to you. They're happening to everyone who is in the market. This morning when I logged in, I was like, massive gulp. But then I also was like, is this an opportunity? Is this an opportunity to take advantage of average dollar costing as certain things that I still feel are solid, good, healthy companies that I'm like, great product, great leadership, great, like nothing has changed in terms of your belief or our belief in certain places where we invest. It's just now means things may be more expensive. Earnings may not be as attractive, but not once have I looked at any of our investments and thought, oh, this could go to zero.
Yeah. And that's the criteria you need to use when you're thinking of sort of seeing a market downturn as an opportunity. Are these companies I own still great companies? Are they just being impacted by something they have no control over?
Right? You got it.
And that is an opportunity to get in and purchase more. And dollar cost averaging, what it does is you invest at specific time frames, no matter what the market is doing.
Yeah.
You get the opportunity to buy things when they're cheaper, and that impacts your growth over time.
Absolutely. You know, this is where sort of starting investing, going through these cycles, building a bit of like confidence because you've been here before, will certainly do you guys well. Being able to look at the account, gulp, and be like, oh, let me reach out. Well, my wealth advisor is Desiree. Maybe I reach out to Desiree. And say, hey, Desiree, how much of this can I stomach? That is so important, knowing that you have the support of a wealth advisor, knowing that you're part of a community of other wealth builders. My biggest objective in having these chats is to make sure you guys do not fall into what the market calls dumb money. The market is relying on retail investors to bail out the wealthy right now. Like they are relying on retail investors to freak out, if you will, sell their stuff at like fire sale prices. And these same traders will come in and swoop them up because they know the fundamentals of these good companies have not changed.
Yeah, and these are investors at the higher level, hedge funds.
Yes.
They have the ability to trade all day, every day. Their opportunity can happen minute by minute.
Yes.
Your opportunity may not be as frequent because you don't have the bandwidth, right, to do something like that. But it's absolutely true. The big traders are trading on fear.
Yes.
To get things that are low.
You got it. And they're also have the benefit of trading massive volumes, right? So they can still make money because they're trading 3 million units of Apple or Nvidia versus you're looking at, okay, my 200 shares or my 100 shares. It's a very different strategy. And I sort of caution you guys as this morning I was listening to all the morning coverage and, people come on and they're sharing what they're doing with their portfolios. I want you to realize that a lot of the people who are talking are solving for being able to show their clients, here's how we made money for you this year. They need to show numbers for this year versus you and I are looking for numbers over 10, 20, 30 years. So do not fall into the trap of like, why have to trade something because the market is doing this. The one thing I want you guys to do is with 100% certainty, go talk to a wealth advisor.
Yeah. And talk about your personal situation, right? And sometimes we're afraid of things that have nothing to do with us.
Yes.
You're afraid because someone told you it's scary.
Yes.
You may be in a position where you can let it rise, right? But you don't necessarily know that really unless you really put a financial plan together and maybe get the insight of a professional that tells you, hey, you can do this, right?
Yes.
Not falling into the trap of everyone else's fear. We all have individual goals and financial goals in particular, and building according to those goals is much more important to you, not what everyone else.
And I'm so glad that you mentioned that, Tanya, because you sort of, I just had a flashback to my '08 reaction to things in the market. And I remember being like, I just need to like change the composition of my 401k. Right. So if I was in, let's say, an aggressive, I was like, I'm not pulling it out, but I'm going to change where it goes, and went to like a very conservative strategy. And then 3 years later, the market is like recovering. And I forgot that I had taken it to a very conservative strategy. And I literally thought I was still enjoying the returns at a more aggressive strategy, and was shocked when I went in there one day. I'm like, what is this? And it might be because the poor decision was made without the benefit of advice and reacting on emotion. And
Yeah.
so for then 3 years, funds were like in lower risk tolerance things. And I really wanted, not growing as fast and probably not taking as much advantage of what that could have looked like.
Yeah, that was a very crazy time for me as well. I had switched firms. I had actually left Merrill Lynch, which then became Bank of America 2 weeks after I left, which is all my stock went down to nothing. But anyway, and I remember meeting a client, an older gentleman, and the market is just tanking. People are so scared. Working with clients, trying to get them through the period we were in. And he comes in and he gives me a $500,000 check. He's like, what am I buying? Hey, here we go. That made my day. I think it made my year because this was an older gentleman.
Understood.
He's like, Tanya, I've seen it all. What are we doing?
I can't say this enough for you younger investors with like 40 more years of investing. Please talk to a wealth advisor. For many of you, this should be an opportunity to munch.
Yeah. Yeah. And
Yeah.
not in one day.
Yes.
This is just as Mical said, we don't know if this is a negotiating tactic, right? And the market would love to find out that it's just a negotiating tactic, but it clearly doesn't know that yet. It might be an opportunity.
There are many folks out there who, if they are betting, they're betting on this being a negotiation tactic. They are swooping up things at these bottom, whatever correction prices, and are waiting for some of these things to get reversed and see some really nice profits.
Yeah.
So realize again, do not follow blindly what you're seeing on these news channels. People have different goals, different things that they need the market to do for them in 2025, and need sort of immediate returns to show their clients and their firms, versus us as everyday investors who are investing to build wealth in the long term and to have really nice, cushy, well-earned retirements.
Yeah.
Two different goals, guys.
Two different goals. And it's an interesting time because interest rates are still at a good point. You could earn money sitting in cash, right? There's hedge opportunities and there's an opportunity to buy valuable companies at a discount.
Yeah. Yes. I know there are clients who are reaching out about T-bills. Is this time to do that? Speak to your wealth advisor. There are many different strategies. And I love how Tanya always reminds you, you don't have to put everything in one strategy.
You don't. Diversification is key.
So key.
And Mical always repeats about the S&P 500, what it is, what it's comprised of. The S&P 500 was a very different vehicle when I started my career than it is from today. The amount of exposure is overweighted a certain sector. There's a lot of international exposure. There's a lot going on there. So figuring out what the right allocation for you is not just the S&P 500. Figuring out an allocation for you will include other things because the market moves.
Yes. I can say it over and over again, so I'm going to say it yet again. I will say it until everyone hears it. S&P 500 is not a diversified investment strategy. It is what everyone has been told to do in the absence of having high quality advice. And you guys have been sold a bad bill of goods. But now there are solutions like Wealthmore where you can work one-on-one with one of our wealth advisors. We have plans that are affordable. You can join the community for free. But I want you guys to understand this. You can go back to our previous episodes. You can Google this if you want. The S&P 500 is not the solution, is not the alternative, is not the right way to have a diversified approach to investing in the market.
It's everyone's diversification target is very different.
You got it. It does not consider your age when you might need the money. I particularly don't like it for older investors because it's such a tech-weighted index, which means you're in a very aggressive growth. And if you are in retirement or nearing retirement, I cringe at what that could mean.
Well, it can't be the only thing.
Yes.
I think that's the point that Mical's trying to say. It can't be the anchor of your portfolio. No one thing should be the anchor of your portfolio.
Yeah.
So there's a lot of investment options out there, and ensuring that you're invested and allocated in a way that works best for you is important. And sometimes you do need help to figure that out. You do need to work with an advisor to figure out, is this the right thing for me? There's tons of information out there, and they're not considering you. They don't know you. They have no idea what you need or what's appropriate for you. Having someone work through your particular financial goals, cash flow, tolerance is important to coming up with a sustainable portfolio.
So guys, I know this is our third tariff episode. I cannot tell you that it will be our last tariff episode.
I hope it is.
I hope it is, but investing comes with risks, volatility in the market, ups and downs. These are not new things, but over time, the market has consistently delivered attractive returns for investors looking to build, grow wealth, and who are comfortable with investing in the long term, not short term. We don't want you guys out here pretending to be traders, trying to figure out where the market's going. We have seen billion-dollar hedge funds unsuccessful at that, with tons of teams, algorithms trying to sort of pinpoint the market. No one has been successfully able to do that. But those of us who have invested in for the long term have successfully benefited from the market doing well. And it's been a big part of building wealth.
Yeah, nice and boring.
Yes.
Boring.
Yes.
For wealth building.
Not feeling boring today.
Oh, it's not boring at all.
Not boring at all, but generally over time, a boring but effective way of building wealth.
Interesting times, folks.
Tanya's here. Our whole team of wealth advisors are on standby. Please schedule one-on-one, download the app, get the advice. You deserve it. It will give you far more confidence and peace of mind around your wealth building plan. And one day, I hope you guys are all like the client that Tanya mentioned, 70-year-old walking in with $500,000 and saying, what should we buy now? I mean, I love it. I mean, that's an investment goal right there. Here's $500,000.
One of my favorite clients.
Yeah. What should we do now? I love that. I wish that for all of you out there. Let that be an ambitious goal, to be at 70-year-old with $500,000 and still have enough assets to be like, how can I use this opportunity to build more wealth? Yes, that's my investment goal story now. Yes.
Wonderful man, wonderful family man, had his own business, but he understood the market. He was never scared.
That is the goal, guys. That is the bright spot, that here we are while the market is sort of doing everything it's doing, but we have the examples of the bright spots for you. Awesome. Well, guys, have an awesome weekend. This is All the Wealth. Please subscribe, download the app. We will see you soon. Our home ownership episode drops on Monday. Tune in, listen to that as well. Home ownership is another key part of your investing strategy and your wealth building goals. Until next time, all the wealth.
Hey, guys.
Bye.